Warren Buffett is hoarding $397 billion in cash, a sum larger than the entire GDP of South Africa. He hasn't deployed most of it in years, even as markets surge. That refusal isn't fear. It's a strategy almost no investor alive understands. In 2026, the global financial system is running two completely different games simultaneously. Most people are playing one of them. Almost nobody realizes there is another. If this channel has sharpened your thinking about capital and patience, consider making that commitment permanent. Your philosophy in the comments below helps build a genuine global community of serious investors. Everything discussed here is for educational purposes only, not personal financial advice. The discipline we examine is rare.
That number would have been unthinkable a decade ago. And what are they trading? Increasingly, contracts that expire within hours. Options with 0 days to expiration, called 0DTE, now account for between 45 and 57% of all average daily options volume on the S&P 500. On days when major economic data drops, that figure crosses 60%. More than half of all options activity in the world's most watched index lives and dies before the closing bell rings. Warren Buffett stood before his shareholders and described what he was watching. He called the modern market a church with a casino attached. Then he said something that cut deeper. Nobody, he observed, can rationally explain why they would buy an option with 1 day left to live. He wasn't being dismissive. He was being precise. Because the mathematics of these instruments punish the buyer with almost mechanical certainty.
A short-dated option near its expiration becomes extraordinarily sensitive to price movement. Think of it this way. A contract worth $1 in the morning can become $5 by early afternoon if the market moves your direction. But that same sensitivity works against you with equal force. A move the wrong way, and that same contract is worthless before lunch. There is no time to recover. There is no second trade. Meanwhile, platforms like Polymarket and Kalshi have turned geopolitical events into betting markets, with 2.3 million and 5 million active accounts, respectively. In 2026, a U.S. Special Forces soldier was charged with using classified military intelligence to bet on Venezuela's political future. He turned $33,000 into more.
The illusion that information moves fast enough for the individual to win. Now consider the man who is refusing to play it. Berkshire Hathaway holds $397.4 billion in cash and treasury bills. That is approximately 59% of its entire investable portfolio, sitting still, earning short-term yields, waiting. The S&P 500 forward price-to-earnings ratio stands at 21 times. The Buffett indicator, the ratio of total market capitalization to GDP, has reached 226.8%. At that level, history says the margin of safety on most equities is thin. Buffett agrees, so he waits. To understand why waiting is itself the strategy, you need a baseball diamond and a man named Ted Williams. Williams was arguably the greatest hitter in the history of professional baseball. His book, The Science of Hitting, described a discipline so demanding it reads like a treatise on risk management.
Williams divided the strike zone into 77 cells, each the size of a baseball. He calculated his expected batting average for every single cell. His conclusion was stark. Swing only at pitches in the center of the plate, where bat speed and contact were highest, and his average reaches 400. That is the optimal zone. That is the only zone worth touching. Swinging at pitches in the worst corner of the zone dropped that average to 230. Not because he became a worse hitter, because he abandoned his discipline under pressure. In professional baseball, a batter who refuses to swing at a called strike is penalized. 3 strikes and you are out.
The rules of the game force you to act. Buffett recognized something profound. The stock market has no such rule. An investor can stand at the plate for years, watching thousands of pitches fly past, and no umpire calls a strike. No one removes you from the field for patience.
The only way to make an error is to swing and miss. Isaac Newton understood this danger from the other direction. One of the most formidable intellects in human history, Newton watched his contemporaries grow wealthy on the rising shares of the South Sea Company. He felt the pull. He invested borrowed money near the peak. He was ruined. He said afterward that he could calculate the motion of celestial bodies, but not the madness of men. Raw intelligence cannot substitute for emotional discipline. It never could. Look at where markets stand today. The forward PE on the S.
Knowing when not to swing solves only half the problem. The other half, knowing exactly which pitch deserves your full commitment and how to prove it before you ever step into the swing, that is a different science entirely. Isaac Newton was the greatest mind of his age. He mapped the motion of planets. He invented calculus. And in 1720, he lost a fortune in the South Sea bubble because he could not stop himself from swinging at a bad pitch. Genius, it turns out, is not protection. Discipline is. In 1970, Ted Williams published The Science of Hitting. He divided the strike zone into 77 individual cells. Each cell had a batting average attached to it. His sweet spot, the high inside fastball, produced a 400 average. The low outside corner dropped him to 230. Williams' conclusion was simple and devastating. The location of the pitch matters more than the speed of the swing. Warren Buffett read that book and never forgot it.
He has said that investing is the one game where you are never called out on strikes. The pitcher can throw 1,000 bad pitches. You do not have to move. You wait for the one pitch that lands in the center of your zone, and only then do you swing. Every quarter, Wall Street generates hundreds of corporate pitches, earnings calls, analyst upgrades, IPO roadshows. Most of them are low outside corner pitches, dressed up to look like fastballs. The discipline is not in identifying them. The discipline is in letting them pass. So the real question is not how to swing faster. The real question is, what does the center of your strike zone actually look like? The answer begins with a word Buffett has used for decades: the moat. An economic moat is the structural advantage that allows a business to keep competitors out and keep returns high, not for 1 year, but for a decade or more. There are exactly 4 types of moat.
The first is intangible assets, the brands and patents that let a company charge more simply because of what the name means. Coca-Cola, Nike, American Express, Apple. You pay a premium for these products, not because they are always superior, but because trust has been built across generations. The second is network effects. The product becomes more valuable every time a new user joins. Meta, Visa, MasterCard. The 10,000th user of a payment network makes that network more useful for the first 9,000. No competitor can replicate that advantage by simply building better technology. The third is cost advantage. Geico, Costco, Amazon, BNSF Railway, these businesses are structurally cheaper to operate than their rivals. When you can serve a customer at lower cost, you can cut prices to win volume or hold prices to expand margin. Either way, the competitor faces a wall. The fourth is switching costs. Enterprise software, specialized banking relationships.
When leaving costs more in time, money, and disruption than staying, the customer stays. The moat is not the product. The moat
is the pain of leaving. But a moat claimed is not a moat proven. The proof is in one ratio: return on invested capital versus the weighted average cost of capital. When ROIC stays well above WACC for years, not quarters, years, the moat is real. Coca-Cola operates across 193 countries. That reach is not geography. It is a fortress of compounded distribution built over a century. Now ask yourself, can you write down 3 objective, fundamentally grounded reasons to own every stock you currently hold? Not hope, not momentum, not because a podcast mentioned it. 3 reasons rooted in durable competitive advantage. That is the rule of 3, and it is brutal, because most portfolios... Peter Lynch ran the Magellan Fund and produced one of the greatest long-term records in the history of active management. His insight was counterintuitive. The best investments often look, at first glance, like the worst story at a dinner party. Lynch looked for businesses that were boring, overlooked, and even slightly embarrassing to discuss. Bottle cap manufacturers, waste management companies. He knew that fast-growing, exciting industries, electronics in the 1960s, personal computers in the 1980s, attracted so much capital that margins got crushed. A boring business in a slow-growth industry had no such problem. Lynch also looked for spin-offs. When a large corporation separates a division into its own public company, institutional funds are often forced to sell immediately. Their mandates do not allow them to hold the new entity. That forced selling creates price pressure with no connection to the underlying business quality.
That is a pitch landing right in the center of the zone. Lynch also tracked insider buying, pharmaceutical patents with durable protection, and companies so ignored by Wall Street that not a single analyst covered them. Low institutional ownership meant the re-rating, when large funds eventually discovered the stock and piled in, still lay entirely ahead. Lynch categorized every holding with precision. Slow growers are mature companies, dividend payers, ballast against volatile markets, minimal risk of permanent capital loss. Stalwarts are reliable giants like Coca-Cola or Procter & Gamble, but they carry an instruction: sell after a 30 to 50% gain, then rotate into others in the same category that have been left behind. Fast growers compound earnings at 20 to 25% annually. They are the source of maximum returns, but the moment growth stalls,
Asset plays carry hidden value on the balance sheet: real estate, patents, cash reserves that the market has simply not yet priced. These require a deep audit of what the numbers actually say versus what the market assumes. Philip Fisher added the layer no spreadsheet can provide. He called his method scuttlebutt. Leave the office. Talk to former employees. Ask suppliers how the company treats them. Ask customers how hard it would be to switch away. Fisher believed that financial statements describe only a past. Culture and human capital predict the future. Fisher's single sharpest red flag: high turnover in the engineering department. When talented engineers leave, product quality degrades silently before it ever appears in an earnings report. By the time the numbers show it, the stock has already moved. But here is what none of this framework can solve. What happens when the rules of the game itself physically prevent you from stepping into the batter's box?
You have done the work. You have studied the moat. You have run the rule of 3. You have applied Fisher's scuttlebutt and Lynch's audit. You know exactly which pitch you want to swing at. Now comes the question nobody warns you about. Can you actually get your money there? This is not a theoretical problem. Strategy without execution is just a well-organized notebook. The batter who knows the perfect pitch but cannot step into the box never takes a swing. Consider Ukraine in 2026. More than 200,000 Ukrainians hold active accounts with Interactive Brokers. That is not a small number. That is a nation of investors who have already done the hard intellectual work, selected the platform, studied the markets, built the framework. And then?
Not because they lacked discipline, because the system itself had changed around them. The macroeconomic environment is not neutral ground. It shifts. Regulations tighten. Capital controls appear. The investor who only prepares intellectually and not operationally is the one left standing at a locked gate when the pitch finally arrives. In January 2026, Ukraine's National Bank issued resolutions number 2 and number 3. These introduced what regulators called a loan limit mechanism. Under this structure, an individual could move capital abroad, but the effective interest rate on that mechanism was capped at 12% annually. Early repayment was explicitly prohibited. The window was open, but it was narrow, and it had precise dimensions. Think about what that means in practice. The rules did not say you cannot invest. They said, here is the exact shape of the door. The investor who understood those dimensions could walk through.
The investor who didn't, or who waited to understand them until the moment of urgency, found themselves studying the lock while the pitch sailed by. So how did disciplined investors actually move capital? One documented route ran through a service called XPaid. The process was not simple. It was not fast, but it was legal, traceable, and repeatable, which is exactly what a patient investor requires. The XPaid route above 50,000 euros required 2 specific documents: source of wealth and source of funds. Not vague records, precise documentation of where the money came from and how it was accumulated. Above that threshold, you do not move until the paperwork is complete. Discipline here is not optional. It is structural. There was also a cap.
The investor who mapped these in advance moved confidently. The one who encountered them at the border scrambled. The actual conversion step in the XPaid route involved USDC, a stablecoin regulated under the European Union's MiCA framework. This content is for educational purposes only and does not constitute financial advice. USDC in this context was not a speculative asset. It was a settlement bridge, a regulated, legally compliant mechanism for crossing the currency gap between Ukrainian hryvnia and European euros. Once converted, the funds moved via SEPA transfer to the Interactive Brokers account. That final SEPA leg completed in 1 to 3 business days. The entire sequence, documentation, conversion, transfer, was methodical. It rewarded preparation. It punished improvisation. For smaller amounts, alternative routes remained viable. TransferGo. Revolut provided SWIFT transfers at approximately 1% in fees. Multiple paths existed, but none of them required zero preparation. Each path required the investor to know, in advance, which door they intended to use. Most investment frameworks treat the decision as the finish line. Find the moat, prove the ROIC, run the rule of 3, buy. But the decision is not the finish line. Execution is. And execution lives in the operational details that most frameworks ignore entirely. Buffett understood this. Berkshire Hathaway does not just identify great businesses. It builds the institutional infrastructure to own them, legally, operationally, across decades. The $397.4 billion in cash and treasury bills sitting on Berkshire's balance sheet is not idle. It is ready capital, positioned capital. Capital that can move the moment the right pitch arrives, without scrambling for documentation or hunting for a legal transfer mechanism at the last moment.
This is the complete picture of what patience actually requires. It is not simply the willingness to wait. It is the willingness to prepare, fully, in advance, so that when the waiting ends, the action is immediate and clean. The unprepared investor hesitates at precisely the wrong moment. The prepared investor swings. Think of Ted Williams one final time. He did not simply stand in the batter's box hoping for a good pitch. He had studied every pitcher. He had mapped his 77 cells. He had decided, before the ball left the pitcher's hand, exactly which zone he would and would not swing at. The swing itself was the last and simplest part of the entire process. The same logic applies to capital deployment. The research is the study of the pitcher. The moat analysis and rule of three are the mapping of the 77 cells.
The compliance preparation, the documents, the transfer routes, the regulatory thresholds. That is knowing where you are standing in the box before the pitch is thrown. Without all of that groundwork, the swing is just a guess. In 2026, the investors most at risk are not the ones who lack courage. The ones at risk are the ones who confuse activity with preparation. They trade constantly. Zero DTE options expiring in hours, prediction markets churning on news cycles, and they call this readiness. They're in motion, but they are not prepared. There is a difference, and the difference is expensive. The investor who survives and compounds in this environment does something that looks passive from the outside. They wait. They study. They build their framework in silence. They prepare their operational infrastructure before the urgency arrives. And when the valuation finally breaks in their favor, they move.
It is not luck. It took years. Patience is not the absence of action. Patience is the accumulation of readiness. Every day you spend understanding a business more deeply is a day you are preparing to swing. Every compliance step you research in advance shortens the distance between decision and execution. That distance is where returns are lost. The work is never wasted. It is stored. Patience finds the pitch. Discipline proves it deserves